Good morning, and thanks for joining us here on Treasure Coast Solutions. Every Wednesday morning that it doesn't rain, we talk about things that you might be interested in.
Hey, it's raining, and we're talking.
That's right. I tell you what, it's kind of weird. Must be this global warming because I felt some liquid sunshine today. It was very unusual for that kind of, to wake up to a thunderstorm is kind of crazy. You know,
I was thinking this morning too, when I was driving in, I can probably count on one hand in the 6 or 7 years that I've been doing the morning show. On one hand, I can count the number of times it's been raining like that when I've drove in.
Yeah, it was nuts. But you get up a little earlier than me, so
a little
that's
bit,
really
like 10 minutes earlier.
Yeah, 10 minutes earlier. I just roll out and kind of roll in. No, my name is Mark Breckbill. I'm a local CPA. I'm a community association manager. Not that means much on this show, and am just kind of involved in a number of business and local activities. And so, on this show, for those of you that are new to the program, we're trying to talk a little bit about finance and economic issues that are out there that might impact you in the future, and some of the things just to think about ahead of the game. Just to be aware that maybe there's some issues out there that could have an impact locally, and I think sometimes that we have a tendency to really forget that things that happen in Europe may have an impact on us, or China may have an impact on us, or Washington or Tallahassee or whatever, until it kind of sneaks up on us. And so from that standpoint, it's kind of interesting that we get so involved in our own lives that a lot of times we just don't pay attention to it. Sometimes we have these issues that are being forced on us, and we may or may not know it until it hits us, and then it's kind of tough. But so I kind of want to explore some of those things and just talk about it. It's a community service program to the extent that you get anything out of it. 220-9788 220-WSTU is the number in the studio, and I'll be happy to take your call if you have a question or want to chime in. We just try to keep it somewhat civil, and you don't have to agree with me. If you don't agree with me, Mike cut you off. No, actually, he gives you extra airtime.
Yeah, I turn Mark's mic off.
That's right, and give extra airtime. So, but and we don't always agree on all of the things in terms of what the outcome is going to be. But some things happen, and there are economic reality that sometimes you just can't deny it. You might want it to be different, but sometimes it doesn't. It isn't different. I think a good example of it. This is to somewhat, political comment, but it's an economic comment, and that's why these things are related. Is that I think there's a whole lot of people in the United States that would be in favor of free education for our youth, free medical care across the board, and a living wage for everyone, and some of those free housing for everyone. I think there's a lot of people that probably would love to see that, but we understand that economically, it's not possible. That you can't you can't do that for everybody. You have to kind of pick and choose, and then that's always the political side of it, who we're picking and choosing it for what, and so it's kind of one of those kind of things where we'd like the numbers to be different. There are a lot of things that have been implemented around the world, and people wished that the numbers had come out differently than they did. But the fact is, economics is kind of a hard science, and certain things produce certain results, whether you want them to or not. The problem is that governments in general have a tendency sometimes to follow that principle of insanity. They do the same thing over and over again, expecting to get a different result, and And most of us know that that's probably not going to happen. But, there's always that ego factor that I can do it better. I can do it right. The other guys did it all wrong. I'll do it right. But unfortunately, a lot of times the basic economics don't change. Now, that doesn't mean that certain programs can't be implemented to solve certain problems. It's just that economically, unless it's funny as an accountant, as a CPA, and as an ex-banker, but as a CPA, I think CPAs generally are taught to focus on the expense side of the equation, and so we tend to be expense people when we need to get a bigger profit. Well, let's cut this. And why is that? It's because most of us, including most CPAs, we like to see the result. We like to know that when we do such and such, we are going to get this result. So if I stop sponsoring an organization or a program, I know I'm going to save money on that sponsorship. I can see that. So how many times do you get a CPA or an advisor, a business advisor, that'll come into you and say, you're spending $1,000 a month on sponsorships for local charities, you shouldn't do that. Why don't you cut that out? Because so they say, see, and that'll save us $12,000 a year. And the problem with that thought process is that that doesn't allow for the revenue side of the equation. In other words, and the problem, the reason it doesn't is because it's not specific. It's very nebulous. So how many new clients do I get from $1,000 a month? I mean, how many people? And it's not a consistent thing, and it doesn't happen right away. So when I spend $1,000 a month on advertising on a sponsorship program that I'm involved in, I don't necessarily see $1,000 worth of revenue come in. If I did, it would be great, even if I could tie it to the revenue, because sometimes the revenue that comes in doesn't say, oh yeah, I came because I saw you're a sponsor of such and such, or I saw you're involved with this organization. It may be, hey, I knew you, I'd heard your name, I saw something, and I decided to come in and check it out. It may be they got a referral from another client, but it was maybe that ad or the billboard or whatever it was that was enough to say, I was going to give that guy a call. I think I'll call him. And so, but that's very nebulous. Who can tie that in? Yeah, you can call them. How did you hear about us? That's the problem. How did you hear about us? Oh, it was a referral. Oh, okay. So now I think that's a referral. So I don't tie it back to my advertising at all because there wasn't a direct advertisement. But the question would have been, how did you hear about us? And what made you call us now? Because that could be a different answer. And even then you may have to dig a little deeper to find it out. And we don't have time for that. And most of us don't do it. And so when your accountant comes in and says, you could save $12,000 a year if you just cut out your advertising expense in this area, there's a tendency for people to say, oh, okay, yeah, I can see that. I could save $12,000 a year. But that may cost you $24,000 a year in future referrals. Of lost business that you could have gotten because you're no longer participating in that. We see that all the time in the banking industry when banks go large, right? All of a sudden they stop, they stop putting money into the local communities because now they have local communities all over the United States. So they can't afford to spend the kind of money that they were spending in their local community when they were a local bank. So the next thing you know, they're providing volunteers, but they're not necessarily spending the money that they were spending. But that's okay because they see that as a reduction they don't see that has an impact on them because it's just they have a budget and they're not going to spend any more on that. So they think, okay, no big deal. But what they don't realize is that local community bank was successful in this community and had a large portion of its community customers because of all of those other things they did. And so will those customers immediately leave? No, they won't. But will they leave down the road? Yes, because now they don't have that tie that they used to have. Is there anybody in Charlotte or New York that's tying those things together? No, probably not. Not really. They're not looking at it specific on that kind of thing because they can't really quantify really quantify the revenue increase or the revenue decrease. And so when we can't quantify something and it doesn't support our position, so that's the other thing. When we can't quantify something and it doesn't support our position if we could, we tend to ignore it. We tend to say it is not a relevant factor, or we don't have enough data, so we can't use it. And so as a result, most people don't focus on the revenue side. Now, entrepreneurs tend to, small business owners know, they understand that concept. That's why so many of them are involved in various things. They understand the revenue side of the equation. They understand that some of that is just faith. And you have to believe that it's going to happen. And then you have to evaluate it over a period of time. And sometimes it works and sometimes it doesn't. But the bottom line is that you always, as a business, should be focused on the revenue side. Why? Because revenue is infinite. You can theoretically always increase the revenue side of the equation. You can only cut to zero on the expense side. So from a business standpoint, an economic standpoint, there is a limit to cost reduction. There is no limit to revenue enhancement. And so now let's take that to the economic side nationally. You know, that's why when we start looking at some of these things, we can't reduce or take away money from the process. So, for example, if I want to institute a program at the federal level, and the way I'm going to do that is by increasing taxes, which is a cost to the person on the other side of the equation. That person on the other side of the equation is going to do one of two things pretty quickly. They're going to figure a way to reduce that cost. So that's either to change what they do so that they don't have to pay that tax, or they're going to cut some other item potentially to offset that cost. Now, should they do that? No. What they should do is focus on increasing the revenue side, because that's the only way. But there's no incentive to do that, because if I'm increasing the revenue side and I don't get to keep any of that, then there's no incentive for me to do that. So that's why it's interesting that typically when a government cuts taxes, total revenue goes up. You say, well, how can that be? You're cutting the rate, so therefore the costs are going to go down. I mean, the revenue is going to go down. But that always ignores the response that the consumer is going to have. When a consumer is faced with a tax increase, they will try to find a way to avoid that. The other side of that is when they get a tax cut, they don't pay as much attention to manipulating their income to avoid that tax, and more of their resources go to other things because they get to keep more dollars. And I think a lot of people don't understand this at the individual level that don't have a business, because they're not faced with it. When you go to work every day and you get a W-2, you get a W-2, and every Friday or every other week or however often you're paid, you actually get a paycheck that represents cash. Your employer doesn't give you an IOU. They actually give you cash, and then you go put it in the bank and you pay your bills with it. But in a business environment, when we make money, we don't necessarily get it right away in cash, nor do we get to keep it. So, for example, if I have if I'm selling $1,000 worth of goods and it costs me $900 to buy those to buy those goods and produce those goods, and I'm going to make $100. So I made $100, but unless I shut my business down right then and there, I'm not going to get that $900. I mean, get that $100 in cash because of a couple things. One, most likely my customer is not going to pay me as fast as I had to pay the cost, because typically most of my customers, or if I'm a business, retail business or whatever, they don't come into the store and say, yeah, I like that dress. Here's $1,000. Order it for me and call me when it's in. They don't do that. May put a deposit down if it's expensive enough, but most of the time, they come in and they say, I want that item, or they go online and they say, I want that item. Well, you have to have that item. It has to already be made. It has to be there. So what happens is that even if you don't start making the item until the customer says, I want that item, you're still not going to get the money to do that. So you're still going to have to spend the money to make the item or get the item before you get the money. So there's a lag in there. There's a lag in getting that $900. Getting the $1,000. I've already spent the $900. So maybe that lag's only a week. Maybe it's only a month, but it's still out there. And it's every time. It's the number. Every item, there's that lag. So as your sales get bigger, that lag gets to be a bigger number. And if you have to have the cash to pay your vendor. Now, you might be able to work terms out with your vendor that you can pay them over time, but a lot of times you can't. One of your vendors is labor, and most of our people don't want to accept an IOU on a Friday. Say, you know what? I'm going to pay you $1,000 this Friday, but I don't really have the cash right now until I collect from this customer over here. And so as a result of that, I'm going to give you an IOU, but when that money comes in, I'll promise I'll give you cash. and then you can go ahead and take your IOU and call up FP&L and say, by the way, my employer paid me last Friday with an IOU. Is it okay if I just send that to you for my electric bill? Because that would be a good thing. And that doesn't happen. So at some point, and it's usually with the small business, at some point that business has to actually front the cash for the transaction. They have to put some money up. Either they're putting labor up and they've paid for the labor, they're putting materials up and they've paid for the materials, or in some cases they've paid taxes and have got to front the money for the taxes because they haven't gotten the cash to pay the taxes yet. And that's where a lot of people don't understand that. So when tax rates go up, not only is it a case that people get to keep less, so there's that selfish reason that people don't do more business when tax rates go up and in fact decrease. If for every dollar I make going forward, I only get to keep 10 cents, and I've got all of the risk that something's going to go wrong, that item's going to be bad, that something's going to happen, I'm going to get sued, that I'm going to, so I've got all that risk still, but I'm getting 10 cents of that. I'm taking a lot more risk for very little reward. So from a selfish standpoint, it doesn't make sense for me to move forward and do that. I'm not going to increase my business. I'm not going to hire more people, because what happens if those sales go down next month? Now I got all these people I got to pay, and I'm going to go broke. So I don't do that. There's too much risk. There's not enough profit to give me a cushion. And even if it's a selfish thing, even if it's, well, you know what? I was going to use that extra profit to buy a vacation home in North Carolina. Now I can't buy that. Well, you say, well, okay, too bad. Well, yeah, but I'm not going to generate the taxes that you need either, because I'm not going to do it, because it doesn't make sense for me to do it. So yes, it may be selfish on my part. I want a house in North Carolina. Maybe not as much as you would like, but generate some revenue for the government to help pay for other things. then you really want me to do that. You want me to do that. You don't want to give me a disincentive to not do it, to stop. And it's this now. That's the kind of you can say, oh, those big bad greedy rich people, and so you can say that. But here's the other side of it that has nothing to do with being greedy. It just has to do with practical. I just explained that in a business environment, particularly a small business, put money back in to keep it going because my cash revenue is always behind my cash expenses. In general, as I'm growing, my cash revenue is going to be behind my cash expenses. So I have to keep pumping money in. The bigger the business is, the more I'm pumping it back in. And I'm leaving it in. Now, technically, I had a right to that money. Technically, I could have pulled it out. And because I paid taxes on it. Technically, it's cash basis. I received the money. I could have paid. It was my money. I could have taken it out. But to do that, I would have had to shut the business down because I couldn't afford to buy more inventory. I couldn't reinvest that money in my business. So as we increase the taxes above the level that I have enough cash to reinvest into the business, you force me to shut down my business. I won't shut it by going out of business normally, although if it was a serious enough situation, I would. But what I'm going to do is I'm going to go out of business in this manner. The first thing I'm going to do is try to find out if I can get my suppliers to reduce their price. I'm going to go to my suppliers, and if I'm big enough and strong enough and I can bully them, I will bully them into reducing their price. By the way, as a segue, we spend a lot of time in a lot of different things trying to convince our kids that they shouldn't get bullied and they shouldn't be a bully. And in life, they're going to be faced with just the situation I'm referring to, and that is bullying, because it's somebody who wants their way, and they are going to try to push you around to get it. So either I am the big bully business, and I'm going to push my supplier around, who's a small business who's faced the same issues I'm facing, or I'm the business that's getting pushed around by the big business. And trust me, the bigger the business, the bigger a bully it is in the business world. You have to deal with that. For example, General Electric is one of the world's biggest bullies because they can get away with it. Because if you want to do business with them, you do it under their terms. You don't do it under your terms. They tell you what terms that they're going to do it under. So, and actually that was considered good business practice. Jack Welch was considered a genius. So I'm just telling you, in the business world, you're going to face this kind of situation, a bully on one side of the equation or the other. And it's always going to be the case. So what's going to happen is this. The first thing I'm going to do is try to reduce my price, reduce my material costs. Now, presumably, I've already done that. Why would I not have done that? If I could reduce my material costs, I can get more, I could make more profit. Why wouldn't I be making more profit? Well, I might like this supplier. I might not have pushed them because they're quick. I may understand that they've been there with me for a long time. So I may not have pushed that supplier, but now I'm going to be forced to. Now all bets are off. Now, the problem is on the other side of the equation, this person that I'm bullying is also getting bullied by the U.S. government because their tax rate has gone up. So they're trying to figure out how to survive. And you're the revenue side of the equation. So now you're going to send less cash to them. So they have even less money on their side to pay for their materials, their labor, and their taxes. So the first thing I do is try to scale back my materials. I might get rid of certain products. If there are certain products that cost me, say, $990 to make, and I'm making $1,000, so I'm only making, $10. At that point, I might say, that product isn't worth it for me anymore. I don't want that product. It just doesn't make enough margin to allow me to have any other costs. I can't have any interest costs. I can't have any other costs that I might need to do. So I'm going to get rid of those low margin products. So the first thing I do is scale back those types of things. I try to reduce my materials. Assuming I've done that or am going to do that and it still doesn't do enough good, then the next thing I'm going to do is I'm going to go and reduce my people. I'm going to try to, and what I'm going to do is probably reduce and get rid of anybody whose job is less skilled or unskilled. So the least skilled worker, which typically is the newest worker, is gone. That's what I'm going to do. They're out of here. I'm going to find a way to mechanize it or do without. Now, if I'm McDonald's, I put in kiosks and you're all gone. Nobody's there anymore. So thank goodness we don't have those $10 an hour jobs anymore, those $8 jobs, because I'm sure those people that were working for $8 or $10 an hour are much happier now being unemployed. But the bottom line is they weren't getting a wage that was sustainable, yes, but they were getting a wage. And the business now is going to eliminate those jobs. And that's exactly what happened in that industry. And it can happen in a number of other industries. I think the estimate is that 45% of all jobs in the United States can currently be eliminated with technology, with existing technology, not with future technology, with existing technology. So if we push business to the point that it makes sense for them to make that in one-time capital investment into that equipment, the labor market is gone at the low end. And those are the people that need it the most. Those are the people that are right on the cusp. Those are the people that you're going to push into support systems and welfare and other things who didn't need it before, but are now going to need it. So the next people to go are jobs. That's always going to be the case. And frankly, jobs are almost always going to be about first because people have already reduced their material costs about as low as it can go. So that's what happens. In the CPA profession years ago, there's a high level of training, education, and everything else that's needed in the CPA business to be able to do tax returns and accounting work and that kind of thing. You got to have, and so there's an expense associated with that. But some portion of our job is clerical. It doesn't require, it requires knowledge. I'm not saying that, but it's more clerical than professional. It doesn't require you to make decisions, judgments, things like that. It requires you to fill out a form or know how to put numbers on a form and fill them out correctly and that kind of thing. Now, that requires some education typically, but it also utilizes technology like tax programs and things like that. So a number of years ago, I always thought it was ironic in an effort to, when situations were different, taxes were a little higher, in an effort to make more money, CPA firms outsourced the preparation of the U.S. tax returns to India. That's the greatest thing I ever seen. Here we are talking about cause and effect. So we've created a tax structure that's so complicated that it requires professionals to do your return because you can't do it yourself. And so you get professionals to do your return. The professionals can't afford to do it and charge you enough to make it make sense. So in an effort to reduce their costs, they ship it out of the country and have a foreigner do it. It's kind of great. People in India knew our tax code better than us. It was pretty cool. But anyway, and frankly, that would have continued. To this day, you would not be having your tax return prepared by a U.S. citizen if the government had not politically stepped in and said, oh, that's wrong. Politically, it's wrong. Now, there was nothing legally wrong with it. Anybody can prepare your tax return. You want to prepare your tax return. And of course, most people were making an effort to protect anybody who was doing it was making an effort to protect the data. So it wasn't a security issue. But the government basically came out to the CPA profession and said, if you continue to do this, we will make life miserable on you. And by the way, if you're going to do it, you have to get them to sign this disclaimer that says that their data is at risk, even if that's not true, that we're having it done by people who might not be competent, even though that wasn't true because many of these people were CPAs. There's all those kind of things that you had to scare the taxpayer and the CPA profession into backing off, which they did. And so, the government, I mentioned briefly about bullies. The government is the world's biggest bully, and the IRS is the person that punches. If when you see that punch coming, it's hard to duck from those guys. But they are bullies, and that's their job, I guess. But when you think about it, the enforcement of that and that side of the thing, they're the ones that do that, and they're the ones that come out here and have to extract this cash from you. So they don't care that you don't have the cash. They and they have all of these things that they tell you, but the reality of the thing is that when you actually get down to it, there is very little leeway. You have to do it their way or the highway, and the highway usually involves prison time. So we probably don't want to go that route. But anyway, so like I said, there's those kind of things that happen, and that area, you just do it their way or do it. So, we've got a lot of these. In fact, I'll give you just an interesting example that most people didn't hear about, but it goes to show a number of years back, the IRS, without really a great deal of thought, I don't think, decided that they wanted everybody to file electronically. Now, they tried to sell that with the concept that you'll get your refund back quicker. All right. So that's what they were telling. They wanted to tell the masses, look, if you file your tax return electronically, we will get your refund back in a week. Okay. Now, so that's what we set up. That's how they tried to sell the process. The CPA industry, we understood that was not their motive. We understood that their motive was that they didn't have enough people to audit your tax return. So they were being forced to audit you electronically. And if you filed your tax return by paper, there was no way for them to have that electronic information. So when the bulk of the tax returns were filed electronically, the government doesn't keep those tax returns on file electronically. They don't enter all that data. They didn't enter all that data into your file. They took and entered key data into your file, and they took the paper and threw it in a warehouse someplace that you couldn't even get it back. In fact, if you get audited, you're asked to bring your own tax return because they don't have it. So could they get it? Maybe in a couple of years, but probably not timely. So tell them to bring it and see how irritated they get. That's not the way to start your audit, by the way, is by telling the IRS, I don't have the tax return, you go get it. But the bottom line is that's what they had you do, is they would just take key information, because the little secret right now is that you're probably not going to get audited because somebody looks at your tax return and sees something that is unusual. You're not going to get audited probably by a random selection. Now, I'm telling you this as a radio host, not as a CPA, but it's probably illegal for me to tell you as a CPA what your audit chances are. But I'm being practical. People should know this stuff, that the fact of the matter is that today, the only way you're going to be audited is if you prepare your tax return incorrectly. If you make a mistake, you put something on the wrong line, they're looking for a number on one line on your tax return because they've received a document from your employer, or a document from somebody you did work for, or a document from a title company when you sold your property, or a document from your retirement plan. They're taking all of those documents with your Social Security number on it, and they're looking to match that up with your individual tax return and find that number. Now, they don't have enough detail probably to find that number individually, but they will know whether the numbers that they got that should be on that line are less than the number you put on that line. So if your sales are $1 million and you received 1099s that are $600,000, they're going to look on that first line on sales and say, okay, it's $1 million. This is 600. They've reported the 600. Now, on the other hand, if they receive 1099s that show that it's $1.2 million, and you only put $1 million on that line, then you got a problem. They're going to come after you. Now, You say, well, they should. Well, no. But because there's two people in the equation. There's you, and you may not have put that number on the line correctly. But there's the other side of it. There's the person that sent in the form, and they may have sent in the form correctly. For example, if you send a form, a 1099 to an attorney, in the old days, they've switched the form now, by the way. But if you send into a personal injury attorney for the amount that you paid them, that number is going to be higher than the attorney actually reports as income, because some of that money that was being paid to the law firm went into their escrow account to pay medical expenses for their client. That's not revenue to them, to the attorney. It's revenue it's revenue coming into their client. So if the doctors, if the insurance company paid in $300,000 to the attorney and issues a $300,000 1099 to the attorney, and the attorney made, let's say, $90,000, the attorney's going to show $90,000, but has a 1099 that shows $300,000. So that's going to cause a problem because the data wasn't correct. But still, you've got to be aware of that. You've got to know what's going on. Here's a common example: retail stores. The charge card companies now have to provide a 1099-K that reports all of your charge activities. And that has to go on your tax return. And it's being sent and matched up with your tax. But wait a minute. What if all of the money that came in wasn't going to you? What if somebody charged something and some portion of it maybe went to the tip? Maybe there's some other stuff that's there that you don't report it on your income. Your income doesn't include that number. Well, I tell you what, it better include that number, because the 1099-K does. So you need to figure out how to prepare the return so that the IRS number, the net. So you need to show the gross somewhere where they expect to see it, so that you can get the correct net number. Because if you don't, they will send you a letter. You'll be audited. The audit is an electronic process. That's why I was mentioning this. It is an electronic matching. And so what happened is the IRS, in the old days, didn't have the data to do this. And what they used to do is a couple things. One, they accumulated certain data and they ran what's called a diff test, which what they do is they take your numbers compared to industry averages for your type of business, for the type of individual you are, or whatever. And they look at the differential score, how far away you are from those averages. Are you in the range? Are you outside the range? And they take that differential score. Now, it's possible that if you have one item that's so large, it could be it by itself could have generated a score high enough to result in an audit. And at that point, what happened is that the tax return was supposed to be kicked out. The office, let's say Atlanta, would get that tax return. They would look at it to see if there was a mistake. Oh, okay, here it's on this line. It's on line 4, not line 3. Or we entered that data incorrectly. So they would look at that, and then they'd say, oh, okay, I see what happened. This is okay. And they'd put it back in the system and make whatever correction. But they didn't have the personnel to do that anymore. So what was happening is, if this thing created this diff test, it would send out a letter to the taxpayer saying, you're being audited. Bring your stuff. And so at that point, they ended up doing a lot of audits where they didn't get any money back because their statistics were bad and their information was bad. So they wasted a lot of their own time, which is taxpayer money. So they had to figure out a better way to do that. So they decided the better way to do that is to get more data, to collect more information in more detail so that our diff test is more accurate and that we have more information to check out, that we can do it electronically. We have more information that we can match up in more detail. So So what they did is they increased the 1099 requirements so that more people had to send more information in, but they also needed to get more electronic data. And so they went to the taxpayer, and it probably made sense. You don't go to the taxpayer and say, hey, by the way, we'd like to collect more information on you so that to be able to audit paper. That didn't go over well. Now, the CPAs, like I said, we were smart enough to know that that's what they were doing because we deal with them all the time. That was their main purpose. It was not to get your refund back faster, but that's what the IRS sold. Now, to do that, they had to, at some point, bully the CPA profession. So what they did is they first tried to get voluntary compliance because they didn't figure they could force the taxpayers to file electronically. So what they ended up doing is they went to H&R Block and they said to H&R Block, here's what we're going to do. If you can get 90% of your tax returns filed electronically, we will not go after you for paid preparer penalties. Now, what a paid preparer penalty is if a CPA or somebody who's paid to do your return prepares the return wrong. They take and wrong to the point. What I mean is they take deductions you're not entitled to. There's no support for the item. There is maybe it's a questionable whether it's deductible or not. There's no case law on it. And so they take a position without disclosing it or whatever. Not only are you as the taxpayer going to have to pay tax, but your preparer is going to pay a penalty directly to the IRS. It's called a paid preparer penalty. And that keeps the preparers from just putting whatever they want on the forms because they, A, will lose their ability to practice, and two, they will have to pay a penalty for it. But what the IRS said to H&R Block is we will not impose that penalty. Now, they immediately got 90% of H&R Block's business. And I don't know if you saw that and remember that ad, but they actually ran an ad that said, we can get more deductions than your CPA. That's the ad they ran. Why did they run that ad? Because they could. Because they could take deductions we couldn't take because they knew they weren't going to get penalized. They knew they weren't allowed to do it probably, or that it was questionable. But they didn't have to ask the questions anymore. They could just take the deduction. Because if anything happened, yeah, you were going to pay taxes, but they were not going to lose their ability to practice. And the IRS did that. And that's how they got the process started. Then after that, they went to the CPAs and said, here's the thing, guys, and enrolled agents. They went to CPAs and said, if you do more than 100 tax returns, you have to file them electronically or have the client submit a notice that says that they told you not to, that they didn't want to. So you can imagine what happens with those notices. Those go right around the diff test and immediately generate the audit letter. Oh, this person doesn't want to file their return electronically. What are they trying to hide? Let's go look at that one. So anyway, so that was what they did, but that still didn't work completely. So then they dropped it down to 10. They gave us 1 year and dropped it down to 10. And so now if we file, I think it's 10 or more tax returns for anybody, we have to do it electronically, and we cannot advise the client to not do it electronically. And if the client now decides to not file electronically, they have to send a form into the government saying that they've decided not to file electronically. So it's, so that's what the IRS did in an effort to, bully the taxpayer to get more information, presumably to get more money for the government and get more compliance with the tax code. But now what happened as a side effect of that? The IRS didn't consider the fact that we've got all this data online. And now that all this data is online, identity theft became a problem. Geez, who would have guessed, right? All this electronic data is being filed without anybody thinking about what kind of controls are out there, including at the CPA preparer level, the preparer level. All of this stuff is now being filed electronically in places where they're not geared up for that kind of protection. We use C&W for our cloud-based system. We have all kinds of security. We have all kinds of ways that people can not hack into our system. So we have a lot of protection so that they can't get that data. But what about the mom and pop that's got a laptop hooked to the internet now, because it's got to be, because you got to file your tax returns electronically, who's just sitting in an office someplace. You don't think that's not a target? You think, well, why would a hacker want to do that? Well, I'll tell you why a hacker would want to do that. 50 tax returns, not a lot, just, a small amount of tax returns. They're doing 150 tax returns. So you say, why would a hacker go after that? Well, because one of the things that the IRS has now suggested, and some states require, is that they want your preparer to have your driver's license number on file. In some cases, you have to actually send it in to the state. But the federal government thinks it's good practices for the preparer to make sure that they have information on their computer that would allow you to unequivocally identify the person that filed the return, which is their social security number and a driver's license. But if I've got a social security and a driver's license, I can create any identity I want. I can get any identity I want. So now what we've done is we've told all of these tax preparers in these little shops that have no money to spend on all of this stuff, here, take these two pieces of information and put it on your computer. Now, the IRS couldn't keep the hackers from doing that, but we're expecting mom and pop to do that. Doesn't make sense to me, but that's what happens. The unintended side effects of IRS bullying is what we got, is being collected just about. I mean, the theft numbers are horrendous in terms of false returns. And why doesn't the government stop that? Why don't they hold off on the refunds until such time as they unequivocally know that that's the person? They've got the W-2 for that person. They've got the 1099s for that person, so that they know that the tax return that's been filed is real numbers. Why don't they do that? Well, because they sold this whole process and you're going to get your refund back in 7 days. If they did that, you'd have to wait until March, because that's when that's when all those things are filed. So they can't do that, because they would have the taxpayers up in arms, but they will. That's eventually, and they've already started some of that, but that's eventually what's going to happen, is they're going to say to you, well, we can't give you a refund back this fast yet, because we haven't had a chance to check the return out. So, it's going to be one of those things where you're going to have to wait 30 days. But they got what they wanted. They got us filing electronically. Got a lot of side effects out of it, but it's what they did. So anyway, that's something for you to think about, because the new tax code which is kind of where I was going. The new tax code is extremely it's actually good, but it's selective. It's individual by individual. So if this year, if you haven't started looking at your taxes, don't wait till the last minute this year. It is a lot different. And it is possible that you may not have withheld the proper amount. By the way, the government, because of that, has waived penalties for underpayment of tax due to the withholding. So keep that in mind as well. Don't automatically volunteer that penalty, because they have waived it, because they recognize in some situations people didn't have W-4s to be able to calculate the number correctly, and they under withheld. So anyway, that's what's going on. We'll talk a little bit more about it coming up in the next few weeks. But thanks for joining us right here on WSTU Digital 1450. We're Martin County's Heritage Station.
All right. Thanks, Mark. You're listening to WSTU Stewart. It's 10 o'clock. We've got Fox News with a look at what's going on around the world coming up right now.